Welcome all to this presentation where we will be getting into a brief history of banking so that you have a really good idea of where the business and the profession of banking actually originated from and how it has steadily been developing over time. First things first though, we have to talk about the etymology of the word bank. So did you know that the word bank comes from the Proto-Germanic words bankes and bankon, both of which mean shelf, which later evolved to the French word banque and also the Italian banca, all describing the modern English word for table. So we can see that bank literally refers to the tables that were used in the ye olde times by the moneylenders in the course of their dealings and when they were going out and about doing their banking business. In the beginning, there were goldsmiths. So a goldsmith was just someone who was a very highly skilled craftsman whose whole job it was to work with gold and other precious metals as well as gemstones. They traditionally crafted jewelry and other decorative pieces for the more noble peoples of this world, let's put it that way. They also tested the purity of precious metals to make sure that they were actually what they said they were. They would repair precious metal items and restore pieces to their former glory if they fell into disrepair, for example. And they also did things like engravings and gemstone setting to essentially make unique pieces for specific individuals and for special occasions, things like that. These goldsmiths naturally handled really precious items, so this meant that they had to have the proper facilities to ensure that they could actually protect the property of their clients whilst that property was under their care. The property that they were dealing with was very valuable, so literally there was no room for error. Due to the nature of their role, this actually opened up a lot of opportunity for them to actually expand their job role. Because they had such strong vaults and such high security, people began to be drawn to this because they realized that they could store different items that they have with the goldsmiths in an attempt to avoid theft, damage, and just for general safekeeping, really. So people began to store their gold and other valuables with the goldsmiths to really take advantage of their high security systems. The goldsmiths then had to figure out some sort of system where they could actually keep track of the items and who owned what, essentially. So they began to issue receipts, which would detail exactly what had been left with them or deposited to them. And these receipts was actually the very first form of banknotes that we are so familiar with these days. This was actually quite an efficient system. So people would just leave an item, they would get a receipt for that said item, and then when they wanted the item back again, all they had to do was just bring the receipt to the goldsmith, with this receipt proving that that individual had a right to that specific property. So they could demand for the item back whenever they wanted to, and the goldsmith had to give back the item. So it was a pretty good system, right? The receipts were what we call these days a promissory note. It was a promissory note because it was actually the goldsmith's promise that should the holder make a demand on the return of their property, the goldsmith would return the gold or other valuable asset back to the holder. So this marked the birth of paper money, the grandfather of the modern day banking system, right? These receipts would actually be used by people as a medium of exchange. And so they were used in circulation to evidence a stored value somewhere neatly tucked away and carefully looked after. People therefore used these receipts and they trusted the value that the receipt represented because they trusted the goldsmith's promise, the promise that they would fulfill the demand for the property in the vault by the holder of that receipt. However, the goldsmiths really started to notice something a little bit funky. They realized that it was actually super rare for people to actually come to them with a receipt to enforce the promise of the goldsmith. So they realized that they had all this gold and other valuable property in their possession and no one to come to do something about it. So they had the absolute genius idea to begin to lend out a portion of the deposited gold to other people, at interest of course, which birthed the idea of fractional reserve banking. This was rather genius because no one would ever notice what was happening, right? As long as the goldsmith always had enough gold on hand, just in case a holder of a receipt did come along and actually demand the fulfillment of the promise, as long as they had enough, this was the perfect plan really. A sure money-making scheme, right? My question is though, could they actually lawfully do this? Lend out gold and other valuable assets that were not theirs in the first place? I mean, can you really lend out property that belongs to someone else without their permission or knowledge? That's definitely something to think about. Anyway, the goldsmiths realized quite quickly that their business as a goldsmith alone was actually not as profitable to them compared to their work accepting and storing people's gold or accepting deposits, and also their work making receipts, so engaging in accounting practices, and also their work loaning out gold at interest. So, in other words, carrying out all the functions and the associated tasks of someone in the business of banking. So naturally, these goldsmiths began to focus on their banking business, most noticeably turning their attention to the creation of banknotes to actually be used as money and circulated in the population as a medium of exchange that has to be accepted by everyone. So by the late 1600s, the goldsmith bankers became really quite central to the financial system, considering that they were literally creating the very instruments that the population at large was actually using to trade with each other to get goods and services to live. So as you can imagine, people began to rely on them quite heavily, relying on the goldsmiths' bankers' business. So much so that all of this banking business that they were doing up until this point was actually kind of an unspoken thing that just evolved over time, but it became officially recognized and formalized in 1694 when the Bank of England was formally established. So now we know how the goldsmiths decided to formalize the whole banking business structure. Let's take a look through the recorded history and evidences that we have, which actually help us to fill in the bigger picture of the concept of banking even before the goldsmiths actually formalized this practice officially. So let's go all the way back to the range of 2000 before the Common Era all the way to 500 in the Common Era. So during this range, a few different civilizations carried out a few different practices which show us the idea of banking in its most simple form. In the Mesopotamia period, it was common practice for places such as temples to be used as early ideas of banks, where people used to store grains and other goods in the temple itself. Then you have in the ancient Egypt and Greek periods, it was common for priests and merchants of this time period to accept deposits of valuables and to also engage in the practice of loaning out those valuables to other people. Then you have in the ancient Roman period, they actually began to develop a much more structured way of doing banking business during this time period, where certain people that had authority to do so, they would actually be authorized to accept deposits, engage in the exchange of currencies or acting as money changers, and they would also lend out money on specific conditions, of course. So you can see just from these few examples that the whole business of banking has an undeniable link to religious establishments, right? With the temples being used as banking locations physically, to the priests who are the ones accepting deposits. So this link is really quite striking. I hope you would agree. Then we move into the range of 600 to 1400 in the Common Era. This range saw a few different developments in the banking practices. Firstly, you have the development of medieval Islamic banking practices, which introduced the idea of credit and also a trust-based financial system which actually complied with Sharia law, with the very prominent focus on avoiding interest, as this was and also continues to be viewed as an exploitative practice. Then we move on to the medieval European developments in banking, which saw the rise in Italian merchant banks, famously associated with Florence, Venice, and Genoa, a very famous one being the Medici Bank. This period also saw the Templars, which are a military order of the Catholic faith, also referred to as the Knights Templar, and also the prominent Jewish financiers having huge influence and impact on the lending practices which were being utilized during this time period. And lastly, we also see towards the end of this period the introduction of the concept of bills of exchange, which was a really early form of credit to the holder of the bill of exchange, which actually acted as an evidence of a liability to the issuer, so the one who actually created the bill of exchange. Then we move into the 1400 to 1700s period. So in 1609, we see the birth of the Bank of Amsterdam, which is commonly considered the first proper recognized central bank. Then in 1694, the Bank of England was birthed, mainly because the government at the time had gotten itself into quite some serious debt as a result of the 9 Years' War fought against France, and as a result, they needed some sort of way to get out of this debt, hence the birth of the Bank of England. This bank actually became the pioneer, as such, of the modern central banking system, where basically they really took it upon themselves to expand and widen the creation and also issuance of standardized banknotes, where they really became the top dog in this field. During this time period, there was also a huge rise in family private banks dotted across Europe, most famously belonging to the Rothschilds, the Warburgs, and the Waldenberg families. Then we have around the 1800s, where the Industrial Revolution was really kicking off. This period saw a huge growth in trade and trading practices, which led to the establishment of joint stock banks, which essentially are banks that are actually owned by shareholders, typically with the option for share ownership in the bank, which could actually be traded on a stock exchange system. Around this time period as well, we also see the growth of other central banks across Europe, for example, the Banque de France in 1800 exactly. So throughout this time period is when we also see the emergence and development of modern check systems and also the use of clearinghouses as well. Then we find ourselves in the 20th century, where many devastating events occurred that had a serious impact on banking systems. So the first was around 1930s, where the Great Depression started in the USA, which impacted nations all over the world because of the quickly evolving and increasing impact of globalization. As a result of this, banking activities began to be regulated quite heavily, which up until this point, banking activities were generally very unregulated, or I would suggest they were just informally regulated because, let's be honest, it wasn't just the average Joe that was setting up a central bank or starting a private family bank, right? Then, after World War II, that's when we start to see the formation of global banking institutions, for example, the International Monetary Fund and the World Bank, both of which were created as a result of the Bretton Woods Agreement, which was signed off in 1944. Then, in the late 1900s, the trendy things at the time and what the cool people were getting involved with was using credit cards, also using ATMs and doing electronic banking. these practices really boomed and they did so on a global scale quite quickly, which of course, as these technologies began to expand on a global scale, they also did so very, very quickly, bringing in the opportunity for risk and things to go wrong very, very quickly as well. So we move into the 21st century now. The start of this era was met with the 2008 financial crisis, which led to some serious banking reforms on a global scale once again. A really key example being the stricter banking regulations brought about by the Basel III, overseen by the Bank for International Settlements. Then we see the emergence of fintech, so technology such as mobile apps and software, which actually allows users to access their finances in a digital format. And we also see alongside this the introduction of digital banking technologies, such as the more famous ones being Monzo and Revolut. And of course, we see the biggest thing at the moment, which is cryptocurrencies. These were introduced and marketed really as a decentralized alternative to the traditional banking system, which is completely centralized and trackable, really a monopoly kind of system. So where will the future of banking take us? Well, unfortunately, I cannot predict the future. All that I can do is study the history and try to identify key patterns which could help us figure out where the trajectory is going in the future. And when you study the history, you do begin to notice patterns that show repetitive cycles, right? Where you really start to notice that nothing is really all that new as such. All that happens is we take the same kind of ideas, concepts, or systems that we already have, and we just do it over again. The only difference is it will be repackaged, rebranded, and there will probably be some new management in town. But if you cut through all of that and you really get to the core of it, we can clearly see that the banking trajectory has become more and more digitalized. And it's quite clear that the future is going to be even more digitalized than it is now, where we can see that there are certain groups out there with certain goals and agendas maybe that want to bring about a movement completely away from physical and tangible value or representation of value, and instead get us to focus on the evidences of value in a digital form, numbers on a screen, which ultimately are just mental constructs that really have no value or meaning until we give it some sort of value and meaning. So it sure is a very interesting time to be alive right now, living through all of these changes that are happening in the technology involved in banking, which is happening right before our eyes in real time and within our lifetime as well. What the future holds exactly, we can't know for certain, but we can be sure that there are certain people out there holding positions in certain companies that have a big influence on the banking system who know exactly in which direction they would like to see things go in so that certain goals that they have are achieved. But all that they are missing between where things are currently and their end goal, all they're missing is participants. They need us to join in on their vision, to play our roles and follow the scripts just as they have planned. The world's a stage after all, right? I mean, Shakespeare did know what he was talking about. And so, as we wrap up this presentation on this brief history of banking, I think it's important just to touch on a few of my final thoughts. I think it's really important that we talk about these kinds of topics to be mindful at all times that our choices that we make can really impact us all collectively, and we may not even realize this on a day-to-day basis or even on a second-to-second basis. But essentially, the choices we make for ourselves will influence the options that we have for ourselves collectively each step of the way, right? This is the effect of globalization. Let's take, for example, right now, we have options, right? like using physical banknotes and coins to pay for things or to use cards for transactions instead. So at the moment, those are the two solid options that we all have to be able to get goods and services to live and enjoy our life, right? Now imagine that out of convenience, we begin to only use one of those options and we shift towards the more convenient option becoming the norm. Naturally, by the law of supply and demand, the other option will eventually become obsolete. In other words, it won't be an option for much longer. And now the illusion of choice really becomes there's no illusion of choice, because it will be quite blatant that there is no more choice. There's one way or the highway as such. These kinds of options and choices, they impact us all collectively. Yes, it will impact your life personally, but it will also impact your friends, your family, your future generations, your co-workers, literally everyone. And as we know, once a collective choice is made to adopt a specific tool, and once our whole life pretty much becomes dependent on that tool, life without it becomes almost impossible and quite difficult to reverse. A great example of this is the use of AI, right? Artificial intelligence. So I guess my final thoughts and my message here is to be mindful that a tool is just that, a tool, to be used to make our life better for those who decide to use the tool, but with the tools themselves having no real meaning. What really matters is who is using the tool and what intentions do they have with using it. What are they really trying to achieve? What's their ultimate purpose? So this brings us to the end of this presentation, where we have gone over the etymology and literal meaning of the word bank. We've gone over the impact of the Goldsmiths in the early modern banking practices. We've looked over the historical timeline all the way from the Mesopotamian period all the way to our current move towards digital banking. We cover how the future of banking is becoming more and more digitalised, and we touch on the impact of tools and the intentions of the user. And that's a wrap on this presentation, all about a brief history of banking. Hopefully this presentation helped you understand quite clearly where banking actually originated from and just how much the banking profession has actually changed throughout history and how it's still changing even at this very moment in time. If you found this video useful and valuable to you, then I am banking on you depositing a thumbs up under this video, maybe exchanging the information with a friend by sharing it with them, and also if you're feeling like taking part in a no-risk investment, then do make sure to subscribe, because our repository of videos, presentations, and information is just something you will definitely want to invest in. So thank you for joining me, and I look forward to seeing you next time. Bye!